Hello friends, today I am discussing the concept of provision for expense. This discussion is mainly for persons with non-finance background. So if you're a non-finance guy, you would have surely received a call from your accounts department to give provisions at the month end or year end. This session will help you to understand the concept of provision for expense, why accounts team asks you to give provision and how to give provision details. First we will discuss why provision for expense is made. Provision for expense is made to ensure that expense during a particular financial year is included in the financial statements of that financial year itself. As you all know, in India, financial year followed is from April to March. So any expenditure incurred during April to March should be accounted in the financial statement of that financial year itself. That is, any expense from April 2019 to March 2020 shall be included in the financial statement of the year 2019-20. We will understand the concept of provision for expense with an example. Say, as on 31st March, Administration Department is having telephone bills for the month of February which they have not submitted to the Accounts Department due to some reasons. Also, as on 31st March, Administration Department would not have received telephone bills for the month of March because the bills of March will be generated only in April. So, when we check accounts on 31st March, telephone bill expense up to January only will be recorded in the books of accounts because February bill is not submitted by the Administration Department and March bill is not received or is not generated. So when accounts department asks for provision for expense, administration department have to give February bill amount as a provision for February and an estimated telephone bill expense for March as provision. So on 31st March, accounts department will record or include the provision given by the administration department for February and March in the accounts by passing what they call as JB or a journal voucher. So as a technical guy, you have to give the provision for expense and the rest it will be taken care by the finance department. So the accounts department asks for provision to ensure that expenses incurred or work done during the financial year which is not submitted to accounts department is included in the financial statement of that year itself. Provision for expenses can be bifurcated under two categories or into two types. First one, work is done and the bill has been received from the vendor but service receipt note or goods receipt note, that is SRN or GRN, has not been raised by the user department nor it is not submitted to accounts department for payment. Second category, work has been completed but bill has not been raised by the vendor. In that case, the user department has to give an estimated value of the work done for providing for provision of expenses in the books of accounts. Now, let's see another example to understand how to give a provision in case of a project which is going on. In the month of January, 25% of the work was done by the contractor and bill was raised by the contractor. Projects department has submitted the bill to the accounts department and the payment was made by the accounts department after making necessary entries in the books of accounts. In the month of February, next 20% of the work was completed and bill was raised by the contractor. But the projects department did not submit the bill to the accounts department as the verification for the bill was not completed. In the month of March, next 30% of the work was done by the contractor, but the bill has not been raised by the contractor. So, as on 31st March or the financial year end, total work done is 75% of the project. But as per the books of accounts, only 25% of the work has been completed because for the month of February work done for 20%, the bill has not been submitted by the projects department to accounts, and for the work done in March, for the 30% of the work, bill has not been raised by the contractor. As on 31st March, we have to record in the financial statement that 75% of the work is completed. So when accounts department asks for provision details, projects department has to give the provision details under two heads. That is, first one, the details of the bills in hand for the work done in February. Second one, an estimate value for the work done in March. So, the accounts department, in addition to 25% of the work already recorded in the books of account for the month of January, will include this additional 50% in the accounts as provision for expenses. Hence, the entire 75% of the work will be shown in the financial statement of that year itself as work in progress. Hope now you all understood the concept of provision for expenses and hope you all enjoyed the video. Thank you for watching the video. Please like the video and click on subscribe button for my upcoming videos. Have a nice day.